Okay, let's unpack this. What if you came across a strategy promising, really promising the possibility of making 2 to 5% profit
Maybe even more.
every single day?
Every single day. And supposedly requires absolutely zero prior stock market knowledge.
None at all, according to the source.
Takes only about 10 minutes daily.
Yeah, just 10 minutes.
And could build what they're calling a lifetime business in just, what, 3 to 4 months?
3 to 4 months with zero competition. That's the package presented.
And perhaps the most striking claim.
Oh, yeah.
Conditional, yes, but asserted. Zero risk.
Zero risk. Yes, according to the source material we're diving into, under their specific conditions, they actually make the case for zero risk.
Yeah.
Bold.
It really sounds like something straight out of a clickbait headline, right?
It really does.
Well, we've done a deep dive into a YouTube video transcript that lays out exactly this strategy. And it specifically uses exchange-traded funds, or ETFs. Right. So our mission here in this deep dive is basically to walk through the strategy exactly as it's presented in that source.
Okay.
We want to understand precisely what's being proposed, the core logic they use to claim it works.
Why they think it works.
Exactly. And pull out all the essential steps so you can really grasp the complete picture they're painting.
Okay, so let's start with those claims then. Those incredibly bold claims the source leads with. This potential for daily profit, you said 2% to 5%.
Mm-hmm. But they even suggest possibilities higher than that, like 6%, 8%, maybe even 10% or more daily.
Wow. And the video actually points out that, mathematically, if you hit even 5% daily, consistently, say over 20 trading days in a month.
Yeah, the math would suggest you could potentially double your initial capital.
In a month.
In a single month. That's the implication.
And what they highlight, which I find interesting, is how accessible they claim this is. Low barriers.
Very low. The source explicitly states you don't need any prior stock market background to actually implement this. None.
Then there's the time commitment, which is incredibly low. Just 10 minutes a day.
Right.
And the vision they present, it's not just about quick gains, is it? It's about establishing this lifetime business.
In just a few months.
In a few months, yeah.
Hmm.
And claiming this specific method has zero competition once you've kind of built it up.
Mm-hmm. And another point they really stress for profitability is keeping costs down, specifically brokerage fees. The source contrasts this strategy with, say, traditional trading, where maybe 30 or 40 rupees out of every 100 rupee gain could just vanish into brokerage.
That's a huge chunk.
It is. So they suggest finding a way to save on that is really crucial for maximizing your actual net returns. Makes sense.
Right, yeah, that chunk out of a relatively small profit is massive. Okay, so those are the headline promises, big promises. How does the source claim this is even possible? It all centers around ETFs, right?
Entirely.
ETFs. Yeah, most people listening probably know what an ETF is, but how does the source frame them? What's their angle that supports these huge claims?
Okay, so an ETF, exchange-traded fund. It's like a mutual fund or an index fund in that it holds a basket of assets.
Right.
But the key distinction, the thing the source really emphasizes for this strategy, is that ETFs are exchange-traded. Meaning you can buy and sell them throughout the trading day on an exchange, just like you would an individual stock.
Unlike standard mutual funds, where it all happens at the end of the day based on the net asset value, the NAV.
Exactly. That intraday tradability is key for their approach.
Okay, so tradability is crucial. What kind of assets are actually in these ETF baskets they're talking about?
Typically, they'll track an index. The source uses Nifty Bs as an example, tracking India's Nifty 50.
Okay.
Or they might focus on specific sectors, gold ETFs, silver ETFs, IT, banking, pharma. You get the idea. It's a collection of top companies or assets within that specific category.
And here's where the source makes its most compelling claim. And frankly, it's pretty extraordinary. It directly addresses that zero-risk idea.
This is the core of it, yeah.
They argue that unlike individual stocks, and they even point to examples like Yes Bank or Reliance Capital, companies that faced massive, massive issues.
Real cautionary tales.
Right. They claim ETFs cannot go to zero.
Cannot go to zero. That's the claim. Their reasoning is because an ETF holds a collection, say, mirroring an index like the Nifty 50.
Right.
If one company within that index or within the ETF's category performs poorly, maybe even goes bust,
It gets replaced.
it gets replaced. It's swapped out for a better performing company according to the index rules. So this continuous selection and replacement process means the collection itself, the ETF, is inherently designed, they argue, for growth over the long term.
If you remain invested.
That's the crucial condition they attach. Stay in the market with the ETF.
So the source's core premise for this near zero risk thing is that an ETF, just by its nature as this managed basket tracking a benchmark, it's essentially guaranteed, in their view, to grow over time if you simply stay in the market and follow the strategy's rules.
Right. That's their foundational argument. That's the bedrock. And building on this, they advocate for diversification through what they call averaging across different ETF categories.
Like gold, IT, banking.
Exactly. Gold, IT, banking, pharma, etc. The idea is that different sectors have different seasons, different cycles.
Sure.
So when one sector, maybe IT, is experiencing a dip, another sector, like banking, might be rising. By holding a mix, you kind of balance out those downturns.
And you benefit from the market's overall upward trend over time, smoothed out a bit.
That's the concept. You average your way through the dips and rises across sectors.
Okay. I think I get the big picture now. The claims, the focus on ETFs, and this unique perspective on their inherent growth and risk profile, according to the source. How do you actually do this, though? The strategy seems to be broken into phases.
Correct. It starts with phase 1, which they call building the inventory. And this covers the first 3 to 4 months.
Building the inventory, like stocking a shop.
Exactly the analogy they use. Like a shopkeeper needs to stock their store before they can sell anything for profit.
Makes sense.
You first need to build up a diverse portfolio. That's your inventory of ETFs.
Okay, so step 1 is getting the raw material, so to speak. The source says go to the NSE website.
Yep, National Stock Exchange website, and download the list of all available ETFs.
And they suggest getting it in a format like CSV or Excel.
Yeah, something you can easily work with, filter, sort.
Okay, download the list. Then step 2, filtering it.
Right, you don't want just any ETF. The source gives 2 main criteria for deciding which ones are even candidates for this strategy. First,
No, debt funds.
exactly, avoid debt funds. They argue the growth potential is just too low for the kind of daily profit target they're aiming for.
Okay, fair enough for their goal. And the second filter?
Volume, trading volume. They specify the ETF's daily trading volume must be greater than 20,000.
Why 20,000?
It indicates there's enough activity, enough liquidity, so you can reliably buy when you want to buy, and crucially, sell later when you want to sell without significantly moving the price against yourself.
Got it. Sufficient activity.
Yeah.
So avoid debt, volume over 20K, you filter your list. Now what?
Now you move to step 3, which is the daily execution routine, the actual buying process. And the source is very precise about the timing here.
Okay.
You check prices and make any buys after 3 p.m.
After 3 p.m. specifically, did they say why?
Yes. They claim that after 3 p.m. is typically when the major players, the big institutions doing hedging activities, have kind of finished up for the day.
Yeah.
And consequently, ETF prices often settle at their lowest point for the day around then. So buying after 3 p.m. is presented as buying at the optimal daily ebb.
Interesting theory. Okay, so after 3 p.m., you look at your filtered list. What's the buying rule?
The rule is identify any ETFs on your list that have dropped by more than 2% since the market opened that day.
More than 2%.
Precisely. And here's a crucial discipline point. You buy only one ETF per day. Just one.
Even if several have dropped more than 2%.
Yes. If multiple ETFs meet that 2% drop criterion, you select and buy the one that has dropped by the largest percentage that day. The biggest loser, essentially.
The biggest loser among the qualified losers. Okay. And how much money do you put into this one daily buy?
The source suggests investing only a small percentage of your total trading fund each day. Specifically 1% to 1.5%.
So if you had, say, 1 lakh rupees set aside for this.
Your daily investment would be between 1,000 and 1,500 rupees into that single chosen ETF. Keeps the risk spread out.
Right. And you mentioned diversification earlier. How does that fit into the daily buy?
Absolutely critical part of the routine. You must intentionally choose ETFs from different categories each day you buy.
So if I bought a gold ETF today because it dropped the most,
Then tomorrow, even if another gold ETF is the biggest dropper meeting the 2% rule, you don't buy it.
you skip it.
You skip it. You look for a qualifying IT ETF or a banking ETF or pharma, whatever, is the next biggest dropper from a different category than yesterday's purchase.
Okay, so actively ensuring sector rotation in your buying.
Exactly. Do not buy from the same category on consecutive days. Spread it out.
Got it. And during this initial 3 to 4 month inventory building phase, the source is really clear on this.
Yes.
You only buy, no selling at all.
None. Zero selling. This phase is purely about consistently accumulating that diversified basket, buying those dips every single day, leveraging that core belief from the source.
That these assets are fundamentally designed to recover and grow over time.
Precisely. You are patiently building the bedrock of the business, stocking your shop.
Okay. So after 3 or 4 months of this very disciplined daily accumulation, buying the biggest dip in a new category each day, after 3 p.m., investing 1.5%, you've built up this diversified inventory of ETFs.
Correct. You should have a decent collection across various sectors, all bought at relative lows.
This leads into phase 2, which the source describes as running the business.
Yes. Now the shop is stocked. You can open for business. This is where the profit generation supposedly happens.
Ow.
Well, just like that shopkeeper sells stock from their shelves when the price is right.
Right.
You begin selling from your accumulated ETF inventory. Specifically, you sell holdings when they have risen sufficiently in price to meet your profit target.
And the source claims that selling strategically from this diversified basket built up over months, that's how you can potentially achieve that daily 5% or even higher profit target they mentioned.
That's the claim. Selling winners from your inventory funds the operation.
And it's not just a one-time sell-off, right? It's a cycle.
Exactly. It's not static. Like a shopkeeper sells goods and then uses the money to restock the shelves.
You take the profits generated from selling those appreciated ETFs.
And you use that capital to buy new ETFs, following the exact same daily buying criteria from phase 1.
So find an ETF down 2%, biggest dropper, sufficient volume after 3 p.m., different category from yesterday.
Yes. It establishes this continuous operational cycle. You buy daily dips to build and replenish your inventory. You sell appreciated assets from that inventory for profit, and then you reinvest those profits into buying new dips.
Maintaining the inventory and keeping the cycle going.
A continuous loop of buy, sell, buy, sell. And the source makes a point of saying this process doesn't require you to learn technical charting, candlesticks, or complex market analysis. It's rules-based.
Okay. Let's just quickly touch on some of the practical details and specific tools mentioned in the source again. They really reiterate the absolute necessity of sticking to those rules, don't they?
Oh, absolutely. Buy only one ETF daily. Ensure that category diversification day to day. And critically important,
don't do this with individual stocks.
Never apply this strategy to individual stocks. Precisely because, unlike ETFs in their view, individual stocks can go to zero. That's a risk this strategy, as presented, aims to avoid by using ETFs.
Right. What about starting capital? Did they give a firm number?
They sort of mention it could theoretically begin from a tiny amount, like 50 rupees.
Yeah.
But realistically, the daily investment guidance, that 1% to 1.5% rule, that seems geared more towards having a larger starting fund to make the daily buys meaningful. Maybe something around the 1 lakh rupee mark they used as an example earlier.
Okay. And the source specifically recommended a couple of resources and platforms, right?
They did. First, they mentioned Cook FM, which is apparently an audiobook platform.
Right.
And they recommended a specific audiobook called Subtle Art of Intraday Trading. Not necessarily for this exact ETF strategy, mind you.
More for general background.
Yeah, more as a resource for understanding some foundational trading concepts, background knowledge.
Okay. And the second recommendation?
Second, they highlighted Shunya as a recommended broker platform.
Shunya. Why them specifically?
The source pointed to Shunya's claimed zero-brokerage model across various trading segments, including ETFs, equity, and even futures and options.
Connecting back to that point about minimizing costs.
Yep, exactly. They position using a zero-brokerage platform like Shunya as a key enabler for maximizing profitability by eliminating those brokerage costs that can eat into gains.
And just to be absolutely clear, these are recommendations made within the source material we're reviewing. We're not endorsing them ourselves.
Absolutely not. We're simply relaying the information and the specific recommendations provided in the source transcript itself, purely informational.
Good. So bringing it all together then, the process described in the source, it really boils down to these 2 main phases.
Pretty much. Phase 1, the first 3 to 4 months, is purely dedicated to building that diversified portfolio.
Right. consistently buying daily dips, ETFs down 2%, check the volume, 20K, wait until after 3 p.m., pick the biggest dropper, only one per day, make sure it's a different category from yesterday, invest just 1.5% of your fund.
And crucially, no selling during this phase, just accumulate.
Just accumulate. Then phase 2 kicks in.
Phase 2 is running the business, where you shift into that cycle of selling from the inventory you bulk.
Selling when those assets appreciate enough to hit your profit target.
And then immediately using those profits to buy new dips, following the same phase 1 rules, maintaining that continuous loop. Accumulation and realization, rinse and repeat.
So this deep dive, we've basically walked through the detailed steps, the rules, and the core rationale presented in the source for pursuing this very specific strategy, aiming, as they claim, to build a lifetime business through trading ETFs.
With minimal time commitment and, based on their argument about ETFs, minimal risk if the rules are followed.
It's definitely a strategy built fundamentally on the source's really strong assertion that ETFs are just inherently different from individual stocks.
Yeah, possessing that built-in mechanism, they argue, for long-term growth and recovery, which, in their view, makes them near zero risk if you hold them through fluctuations and manage them according to these specific buying rules.
Okay, so here's maybe something worth considering, based on everything we've just unpacked from the source.
Go on.
Think about that core distinction. The source hammers home the idea that individual stocks can fail completely, go to zero, kaput.
Right.
But diversified ETFs, because of how they're constructed, how components get swapped out, they are essentially, according to this source, guaranteed to recover and grow over the long haul if you just stay invested. Does that fundamental difference, as presented by the source anyway, does that change how you might view assets or even think about market risk?
It's a provocative thought.
It is. And how does that concept of building an inventory of assets, like a shopkeeper stocking shelves, compare to the maybe more typical approach of trying to pick individual winning stocks or time the market perfectly? It presents a very different framework for thinking about trading or investing, doesn't it?
It certainly does. A much more systematic, almost industrial approach if you follow their logic. Definitely something to mull over.